All right. We have a nice, healthy group of people on. I just want to welcome everybody to the Loyola Family Business Center's September webinar, Economic Predictions for Family Business. I'm Ann Smart. I'm the director of the Family Business Center. And so for those of you who may not be familiar with the Loyola Family Business Center, we're a center within the Quinlan School of Business at Loyola that supports middle market sized family-owned firms and the families that own and manage them. We offer peer groups, segmented executive education programs designed to support next gens, shareholders, and the governing bodies for both the business and the family. Our confidential community is made up of about 80 Midwest-based business-owning families, each of whom are committed to the sustainability of ownership, their families, and their communities. As part of our COVID response programming, we have been offering just-in-time virtual programming like this webinar today. I am delighted to bring another relevant and topical program to share with our members and friends. Okay, I'm gonna get my... in a moment, I'm going to welcome our speaker, Mike Stritch, Chief Investment Officer of BMO Wealth Management, and his colleague, Todd Riggin. But before I do that, I've got a little bit of housekeeping. We're expecting over 100 people on the call today, so please keep yourselves muted. Mike and his colleague Todd will be happy to answer any questions via the chat throughout the presentation, and I will be monitoring the chat today. They have a lot of really good information in the slides today and their presentation, so please use the chat box, and when I have a question or you have a question, I will share it with them. And they would love to be able to answer in real time. So let's get started. Over the last 9 months, I think we wish we all had a crystal ball and we could see into the future. Last November, Todd Riggins, Director and Wealth Advisor at BMO's private bank, invited me to join him at dinner with some CEO clients and Mike Stritch. Mike and Todd were great hosts. The table exchange was really lively, and the group of CEOs were generally bullish about the future. One comment made by Mike remained with me after that meeting. When he was asked about the 2021 election, or the 2020 election, Mike said that based on his research and the information they had to date, that Donald Trump would probably be reelected unless there was an unprecedented economic downturn or disaster. Dun, dun, dun. So Mike might not have a crystal ball, but he and his team have been prescient in their understanding of the future state, for sure. So we're delighted to have them with us today, and I'm going to turn it over to Mike and Todd.
Thanks, Ann. Appreciate the introduction there. And as Ann mentioned, Mike and I are excited to be here today, be part of this group. We've certainly valued the group at Loyola and look forward to today's program. But before we get started, I wanted to just spend a minute on introducing BMO. So BMO Financial Group, we've been in business for over 200 years. We're actually the 8th largest bank in North America. We've got about 12 million clients that we serve, and Mike and I are both part of the wealth segment. So we work with individuals and families across the country, really helping to bring the best solutions, the best thinking, and in these volatile times, the best information. So we hope you enjoy the discussion today, and look forward to having everyone on today.
Great, thanks, Todd, and Ann, appreciate the introduction here. Maybe Ann, you can go to the next slide. And I also did enjoy that dinner we had back in the fall of last year tremendously. In fact, it was right around the time that we did our annual outlook for the next year. And so we had just wrapped up that process, and you can think of it as a bunch of folks sitting in a room for a couple of days, sort of kicking ideas around as to what the most influential themes for the upcoming year would be. And, you know, we start with, I like to think of it as a funnel. We start with this big list of topics, and then we gradually knock them down to maybe the 2 or 3 that we feel most important for the year ahead. And, you know, interestingly and ironically, global pandemic was one of the ideas at the top of the list as a risk factor, but it got eliminated really quickly. And of course, no one could have known back then what we might have been in store for in 2020. So we'll talk a little bit about how we responded as a group, as well as thoughts on the election today. I'll start with some market context just to make everyone familiar with kind of where we've been in the markets, to the extent that you haven't paid too close of attention. But before I do that, I just want to mention here that my role at BMO, as outlined, is really head of investment strategy for the U.S. We've got a great team, and our group is really founded on the premise of a handful of key beliefs, which are listed here. I won't go into detail on those beliefs specifically, but everything from our culture, our values, our process, our oversight is covered in this, belief circle, if you will, right here. And we would obviously at some point love to spend more time with any of you talking about this specifically. One of the things on here that you'll see on the bottom right, decisions should not be outsourced. That's a key belief of ours. And in the U.S. wealth business here at BMO, we have about 35 folks that focus solely on research and strategy across all various disciplines, from individual equities to fixed income and the like. And that's the core group that sets the view that I'm about to present to you today. And that's in partnership with other folks around BMO. As Todd alluded to, it's a big firm, about 45,000 people around the world. That group of 35 here in the US works specifically with our partners in Canada, Europe, Asia, and the like, to kind of formulate those macro themes as well. So with that, Ann, let's talk a little bit about the market. If I could skip forward to 2 pages here. So that'll be page, one more there. A little table, asset class performance on a year-to-date basis. Now this data is, at this point, we're near the end of September. This data is through the end of August, so it's a few weeks old. We've had a little bit of a sell-off in September, but the point remains the same. If you look across this table, we've got August results, but more importantly, year-to-date 2020. Whoops, if you go back one there and just stay on that last page for a quick second. The big winner this year had been U.S. equities, U.S. large cap equities, and U.S. large cap growth equities. So when we get back to that slide, you'll see it, but there's a huge dichotomy in the performance of the underlying composition of U.S. stocks, for instance. And you'll see there that the IT section, information technology there, as of the end of August, was up a resounding 36%. That's, the S&P sector equivalent to the NASDAQ that you might see quoted often in the press, but technology has had a huge run, as had some discretionary stocks, as well as some other communication stocks. So these are kind of the growth area of the marketplace. Very successful year. The more value cyclically oriented names, if you think about industrials, financials, energy, and materials, have struggled. And that's been the theme globally as well. U.S. technology dominant stock market, Europe, Japan, more industrial, financial, cyclical. So the U.S. has been the big winner this year. Large firms have been the big winner, and large technology-oriented or growth-oriented firms have been the big winners. Bonds have also done extremely well. If you look down in the middle of this table, core fixed income, you can see core taxable bonds, they're up about 7% or so as of August, given the tremendous decline that we've seen in interest rates that many of you, I'm sure, are aware of. So that's a little bit of the backdrop. From the end of August to now, I think we've lost about 7 or 7.5% on the S&P, so we're up a couple of percent, but it's really amazing if you think about it from where we've come to just say that we're still marginally positive given what has happened earlier this year. So if you do go to the next slide here, Ann, really quickly, I've broken down the performance in a little more granular level. I often get asked about this idea that is the stock market disconnected from the economic environment? And we'll talk more about the economic environment in a moment here, but my answer to that question is perhaps, but for the most part, I would say not. And if you look at the sector breakdown here, you can see First off, that the dispersion in returns across sectors has been extremely large. And if you stack up the winners against the losers, an easy theme emerges. Stay-at-home winners, internet catalog and retail, hardware storage, and technical support systems, winners, right? How many of you on the line here have bought new equipment for home offices or perhaps for your children and their school needs and things like that? On the flip side, at the bottom, on the other side, you see things like oil and gas, energy. If you zoomed in on a couple of those other lines, you'd see a lot of the leisure and hospitality areas as well. So those big ticket travel, discretionary spending type of items suffered at the expense of some of the more technological and computer equipment, internet retailers. So it really has been a theme this year of a separation of winners and losers, much more so perhaps than we've seen in the past. And I'm going to pause here for a quick minute, because I do want to introduce a poll to the group. I'm going to transition from where we've been to our thoughts on where we're going a bit more. But before we do that, I'd like to take a quick pulse check, right? We've had a huge fall off in the market this year, a significant rally led by a handful of industries as shown on this chart. And I'd like to ask the group how you're feeling personally about the market and potentially the expected return for the next 6 months. So a really quick poll, if we can get it up there. And I think I would just ask everyone, how do you feel about the prospects for the stock market over the next 6 months? Are you feeling good and bullish? Are you feeling, I'm not so sure, a little more neutral, or maybe perhaps a little bit bearish? So if you could put that in there, I think it'd take a minute. Go ahead, Ann.
The poll is up, and I'm going to see if I can do a new share so people can see it. Let's see. Nope, I can't. So I won't. But I can tell you what it says. It continues to be, we're adding people all the time. The options are bullish, neutral, and bearish. And at this moment, we have responses from 50 people, 51 people. And they continue to grow. Okay. We have 74 people on the line, so I'm just going to encourage you, if you can, to jump in and fill out that poll. It's super fast. Options bullish, neutral, and bearish. And
next 6 months.
Yeah. So how do you feel about the prospects for the stock market over the next 6 months? 7 people, 13% bullish. 31 people, 57% neutral. 16 people, 30% bearish. So I don't know if that is a surprise to you, Mike, but it's kind of a surprise to me that that many people are neutral.
Yeah, that is an interesting one, the neutral. I was expecting, to be honest with you, and if you want to flip to the next page, I'll talk a little bit about some of our main metrics.
I'm going to do the poll, and then I'll go to the next page.
Sounds good. Yeah, that's a pretty astute answer, I would say. Maybe it's not that different from what my answer might be if you ask me for the next 6 months as well. But it is a little bit of an outlier as it relates to the general consensus, I think. And there it is. Yeah, there's the results. That's great. The general consensus, and it does skew neutral to bearish a bit, right? We have only 13 folks bullish for the next 6 months. And the reason that I wanted to ask that is, as I flash up here our dashboard for domestic equity. So S&P 500, if I'm not sure if anyone on the line is subscribed to any of our research or gets that updates, but essentially you'd be familiar with this 5 key sort of pillars that we build our thinking around for the US stock market. And you can see them listed on this page: valuation, economy, liquidity, sentiment, and technical. Each one of these has a series of underlying metrics that powers it, and we feel like it's a very robust process that helps us form the baseline of our opinions going forward. But it's not the end of the story either. It's really just the starting point. And the reason I wanted to highlight it is, specifically, if I rewind over the last several months, the lone holdout on the positive camp had been that sentiment indicator there. If you see that firmly stuck on the bullish number one this month. Previous month, if you go back a month or two before, it was in a similar position. And sentiment, as we think about it from a investment perspective, is typically a contrarian indicator, right? If people are feeling really good about things, back to the 1990s irrational exuberance quote from Alan Greenspan, people are feeling really good about things, that tends to be difficult to sustain in the intermediate term. Conversely, if people are feeling very anxious, nervous, concerned, that tends to lead to positive outcomes for the market because people haven't committed. There's extra cash on the sidelines. And this sentiment measure here encompasses a variety of different indicators, some of which are survey data from various surveys of investors, some is institutional positioning and the like. And you can see here it's firmly in the one camp because the average investor, the average, I would say, high net worth investor or institutional investor has been leaning more to the nervous side than the positive side recently, which does tend to suggest good things are in store for the stock market in the ensuing months. And this was in the face of a huge rally that we saw. So sum up on this page, your results are a little bit off, I think, from the general consensus, which is very astute, I think, in your submissions. The general consensus says people are feeling pretty negative today, and I think that represents good things for the market to come. So sum it up for our feeling on domestic equities. We are marginally positive on our outlook for the S&P 500 based on these sort of quantitative measures. We'll talk more about the election and some other things that are influencing our thoughts, and we'll wrap up with our final comment on positioning at the end of the call. Before we get into the economy, I do want to spend one more moment maybe just to take a walk down memory lane. If you go to the next slide here, Ann, real quick. This is, I think it's always good to be transparent. This is a slide that sets up what we've done this year as a group in response to the market action and where our positioning has been. And if I take us back to January 2020, so long ago at this point, we came into the year feeling pretty optimistic. Ann mentioned that dinner we had late fall 2019. If you rewind back to that, the story of the day was trade tensions, trade war, manufacturing slump. Our view was that we were ending that sort of heightened trade war tension period, that the manufacturing slump had run its course, as you see those things play out typically in 18 to 24 month cycles, and that 2020 would be a decent year for economic growth and corresponding stock market performance. Well, we were on our way there, and then, of course, we had the COVID-19 pandemic hit, and it hit fast and furious. And there's the S&P 500. You can see, obviously, and everyone remembers back in February, March, the tumultuous tumble that we took in stocks. And really, every asset class saw a period of severe stress. Since then, we've made a couple of decisions. You notice at the bottom, there's a little circle there. We did suggest back in March to our clients that we should be adding to equity positions in earnest, because we felt like the risk reward was shifted decidedly, given how far and how fast we had fallen. And in hindsight, that has obviously proven to be a pretty good decision. And then along the way, there's a couple other circles there. And we've basically been, since that point, focused on managing risk. We've reduced our exposure to some of the weaker links, what we feel like in the overall chain of possible outcomes. That would be below investment grade credits, certain emerging market debts. And that's what we have focused on continually, this idea of risk management since then, and letting our equity winners run. And we've been really focused on the equity side on the large cap US quality growth theme, as I mentioned earlier. So that's been the history that BMO has experienced over the past several months. Right now, our current positioning is still overweight equities, if I was to look at our baseline recommendation, but every recommendation is customized for clients. But today we're overweight equities, but we also have some extra cash on hand, as I mentioned, that we've raised over the last few months from other areas such as high yield bonds and international debt markets. And that cash is meant to survive, to be a buffer should we get a period of volatility here heading into the election, whereby we could maybe dip our toe further into the equity market. So that's a little bit of where we've been, a little bit of context on the markets. I'll spend the rest of the time here talking about the economy, as well as some comments on the election. Then we'll wrap it up with some time for questions. So if you will, Ann, here we go. We're going to talk for a handful of slides on the economy and the virus's toll on that. First off, I'll start where we've been, right? Here's some slides. Shortest recession in history is the tagline here. Many of you have probably experienced that in your businesses. You've certainly seen it in the news. Here we have payroll, employment changes month to month. We have personal income and outlays, so consumption, income changes, industrial production, all changes over the past several months. If you look at this on a change, what do we see there? The proverbial V that we've heard discussed many times in various publications. We're not one for a lot of these alphabet type of names, but in terms of a change, we've certainly seen a dramatic fall and a rebound across many economic indicators. So this would be the shortest recession in history. Obviously, if it holds up here, which we think it will, average post-war recession has lasted about 11 months. One of the things that it's worth noting here, this recession obviously arrived via an exogenous shock to the system versus a buildup of economic or financial imbalances. We had been arguing or positing regularly in the months leading up to the pandemic that 2020 really started the year, despite the strong kind of stock market performance, despite the continued economic recovery and consistent upward economic momentum since the financial crisis, that we started the year with little excesses. There were some hints of it, maybe in borrowing for smaller corporations, but from a consumer perspective, which is the bulk of the US economy, consumer was in pretty good shape from a liquidity and a debt position. And that has certainly provided some extra ballast during this year's crisis. So that's where we've been. If we think about where we're going, you want to go to the next page here, Ann, and we can see, just some charts on GDP and payroll employment. And again, it's no secret that it's been a significant knock to both employment and real GDP thus far. If you look on the left-hand table here, we can see back in time, back to the financial crisis, we had about 8 quarters from trough to back where we had been in previous highs. So, and it took us 8 quarters to recover on a GDP basis. Right now, for BMO's forecast, we would expect at this point for a full recovery in GDP somewhere close to the end of 2021. But I think that recovery is going to be bouncy and it's going to be a bit wavy, and it's going to be conditioned on a handful of things, obviously not the least of which is progress fighting COVID-19, which we'll talk about in a moment. So right now, though, the base case for us is somewhere near the end of 2021, maybe early 2022, we would see kind of a return to previous peak GDP levels, which is a shorter duration, obviously, than the financial crisis return to previous peaks. From the employment standpoint, we're at about 8%, 8.5% on the unemployment rate today. We would anticipate that it holds right around the 8% through the rest of 2020 thereabouts, and ending 2021 somewhere in the 6 to 6.5% range. A key theme will be, again, winners versus losers. The difference is going to be, the makeup might not be the same as it was previously, right? We think industrial production has more room to grow. Onshoring has more room to go. Leisure, hospitality, and the like probably don't come back nearly as strong in the immediate future. So I'll close this slide by just saying formally our projection for real GDP is to be down about 4.5% for 2020, with perhaps a 4 to 4.5% growth number on real GDP basis for 2021. maybe closer to 5%, though that estimate is right now in flux because of sort of lack of clarity on another round of fiscal stimulus from the government, which we will talk about in a moment. But all in all, we do think things get back to kind of normal from an economic front by the end of 2021. It should be quicker than our last recessionary period, which is after the financial crisis. So we talk about how we're trending really quickly. Here's a little bit of a checklist. We could put a host of indicators up on this page. We've just chosen 4 to cover the spectrum. Some of the things that we're watching in a more real-time fashion, so monthly data points or more frequently. You can see unemployment claims, of course, weekly number. We've had a tremendous improvement in new unemployment claims, but we've stabilized over the past several weeks. That's been an item that's been broadly discussed in the news media. Again, we expect that to be probably in this area for a little bit longer, as I mentioned, thinking that end of the year we are in the 8% range still for unemployment. So we've kind of reached a bit of a plateau there in the short run, but we'll see. Maybe we'll get surprised on the upside. Looking down, so that's kind of a negative a neutral, I'm sorry, in terms of where things have trended recently. We have an X at the bottom here, sentiment on the part of the consumer. This is one of the various indicators, University of Michigan consumer sentiment. You can see the huge drop off that we saw. It started to creep back up and then we plunged again, perhaps on the back of some of the social unrest this summer, perhaps on the expiration of some of the unemployment benefits. But we did sort of get a reversal there. The good news is this was last month's data. This month data just got released and it actually bounced back up to 79. So that X would kind of go back to more of a neutral. So consumers are hanging in there, I think. And that's going to be a big theme to watch going forward, is just how resilient will the consumers be, especially if we don't get, again, an extension perhaps on the unemployment insurance front or other fiscal measures in the near future. On the industrial side, though, you can see ISM manufacturing numbers quite strong on a rebound, non-manufacturing as well. So this is the Purchasing Managers Index, again, 50, number greater than 50, signals expansion, less than 50, contraction, and we've seen a significant rebound in both manufacturing and non-manufacturing indices for the larger companies. And then down to bottom, one thing not to be overlooked. Many of our analysts actually that we have at BMO are talking about this idea of sort of a golden era for housing again. And housing starts have been very strong recently. Existing home sales actually came out this morning again, about $6 million number, $6 million units, so above last month. So the strength in the housing market has been good. Housing does not represent nearly the same contributing factor to GDP as it did prior to the financial crisis, because it's had a little bit of a muted and prolonged recovery. But the good thing is housing is got a great multiplier in that build a house, it contributes to a whole host of other industries and jobs. And so this and auto sales, frankly, are two of the highest multipliers out there. So this is a good news story, and we expect the housing trend to continue for a couple of reasons. As I mentioned, interest rates, mortgage rates, near historic lows. People are feeling like they want to maybe move out of some of the more crowded urban areas on the back of the pandemic, and of course some of the other things that took place this summer. And also you just have a pent-up demand from the millennial generation that was slower to start forming households, which they are doing now, and that comes with expectations for home ownership and the like. So that's a good news story, and one that we expect to continue. Of course, all of this economic momentum here is contingent upon trends in the pandemic. And if you want to flip to the next page, Ann, we can talk about some of those more recent trends and how we think about it. Here's a chart. You've probably seen many variations of this on the left-hand side, just new cases in the US, initial spike, drawdown, and then a resurgence over the course of the summer, mainly focused in a number of southern and western states. If you look a little bit more detail at the current results, we have seen a bit more of an uptick lately. So if we extended this chart another week or two, case growth has picked back up in the US. I think we hit about 50,000 new cases on Saturday, and that is up from a low of about 24,000 this month on September 7th. So a pretty big increase over the past several weeks. Most of it has been in the South still, but some in the West and Midwest. For those interested in Illinois, has been running in that 1,500 to 2,000 range pretty consistently for the past month or so, which is a little bit higher than we were in the summer months. But the big factor that we like to focus on is really this idea of hospitalizations, net hospitalizations in particular. So, a closer look at the occurrence of more severe cases. And the good news here is that despite the recent uptick, and even the summer uptick, you can see hospitalizations didn't reach anywhere near where they were earlier in March, and they haven't yet rebounded to a significant degree. I think it's, again, probably widely known, but this is mainly because of the people that are contracting the virus today tend to be different, in particular younger, than the initial surge, which is helping keep hospitalizations down, which is allowing people to feel not as quick to sort of curtail economic activity. And so if you take a look at the next page here, and we can talk about one of the...
Mike,
Go ahead,
go ahead. We have a question from the
Sure.
audience. From David Roberts. Please address how this recession has affected different industries and different communities very differently. Travel, hospitality, et cetera, have been hammered compared to tech, healthcare, et cetera. Given the concentration of minorities in the hospitality industry, their jobs have been hit very hard, with weak healthcare coverage leading to real differences in economic and psychological impact.
Yeah, I mean, there's not much more to comment than what that was stated, because that was stated pretty well, and it's a very good and important point, and it just reinforces the notion that we started the conversation with, that was evident also in those charts about industry performance. There is a decided group of winners and losers, and this pandemic this year has only further exposed those gaps, right? I think about the stimulus as a for instance. There is a good portion of the population that is living right on the edge and is very in need or hopeful that that stimulus package, the next package, would get passed, because it's very important to their viability and their survival. And on the other hand, there is a group of people that is comfortably working from home and is able to exist as if there is little to no disruptions to normal course of business. And that's what we're seeing play out. In part, it's manifesting itself in the, in the political and the social commentary that's beset us. And we've been talking about this for a number of years, going back to Brexit, frankly, in the first case, when we had the first sort of populist type of a movement where there was a class of people that voted to say, we feel like we've been left out from the gains that have accrued since the financial crisis, because people that owned assets, stocks, real estate, businesses in general, benefited significantly, while those that didn't, were faced with, maybe increasing wages, but not as significant as the folks that had asset ownership. And this situation has further widened that divide, and that's a big part of, I think, trying to understand what the implications are politically to help us think about what the implications are for the market. Because again, our job here in my role is really to think about the political wins and the likely scenarios and overlay them onto what happens to the capital markets, not to make any commentary about the right or wrong of what the political outcome might be, because as we know, it's a pretty polarized world that we live in today. So that was a very spot-on comment. The gap between the winners and losers has grown bigger over the past several months and has led to more tension, for sure, under the covers of the economy in the US and globally. Frankly, it's not just a US phenomenon, as I mentioned, saying that Brexit was the Kickstarter in terms of a formal foray into the populist movement. And so let me just finish a comment or two on the virus here and just say that there's a lot of other more high frequency data sets that are available, perhaps not used as much in the past as they are today, because there wasn't a need to look day by day and see how things were trending. But one of the things you can do, you can go on Open Table actually and get this. They released a data set. There's a couple other things. Google does it, Apple does it. So contributors to try to understand how people are moving around in the environment, what's their reluctance or willingness to get out and spend money and be in the economy outside of the house. I found this Open Table data set to be particularly interesting because it's tracked the trends well overall. So you can go on and look at seated diners, online phone and walk-in, year-over-year comparisons. So it's a little bit noisy because you might have a holiday that falls on a different date. So you have to look at kind of the averages as opposed to the specifics. Two things that will be interesting if you were to study this data in more detail. One, when it comes to the government lockdowns that took place, this data and these other high frequency data sets fell off the table, no pun intended, before the lockdowns became official. People acted in their own self-interest before being told not to go out by the government. So that was the first thing. So that's just to say the government mandates are, maybe effective, but really people hunkered down because they felt afraid of what would happen if they stayed in public. And as we go back here now, we watch things come back. We've seen it map pretty good with the virus trends and that hospitalization number in particular. A little bit of a leveling out in the summer months, and now we've started to see a gradual uptick again in this and some of the other more high frequency data sets. So that portends good things in the short run for the economy if we do keep that hospitalization rate down, right? I think we can withstand the back to school press of increased caseload as long as hospitalization rate doesn't increase dramatically. Illinois is basically kind of net zero. We haven't seen a big move up in the net hospitalization rate in Illinois to this point, which is a good thing. And I think that's a key factor that you might want to pay attention to when you're looking at the data coming in the nightly news feeds and things like that. Hospitalization or severe cases, I think, is the primary indicator of how people will be, the willingness of people to engage in activities outside the home. A quick look across the world, if you would, Anne, for the next slide, just to put some context on it. We've seen dramatic decreases in caseloads from peak across the world. The outlier here, this is really, with the exception of China, all developed markets. I'll talk about the emerging markets in a moment here, but Spain, of course, this is through September 11th, Spain has seen a pretty big resurgence. And fast forward even from September 11th to today, we've seen some strains elsewhere in the European Union, in particular UK has made some pronouncements this morning about perhaps, they are limiting movement and are again promoting a work from home environment, as well as closing some of the pubs and things a bit earlier than had been previously approved. So we are seeing a bit of, again, this kind of, if you call it a second wave, or just the general waviness of this, which I think is a theme, both for the virus and for the economy, what we're going to be in for over the next several months. But by and large, before the last couple of weeks, we had seen good progress around the world, with the exception of the emerging markets. India in particular, South America in particular, are still struggling to keep new cases down, as they've been running in significantly higher numbers day after day almost. So the big thing to be watching here again is the severity of the outbreaks, and if other countries start to follow maybe the UK's lead in suggesting the need for more stringent measures, that will dictate a bit of the economic backdrop as well. And it's given the market a little bit of pause here in the last couple days. too. Again, our view is that that's not the base case. We think that people will try to to live with the virus and be more targeted on the measures from the different governments. And as long as hospitalizations don't dramatically spike, people's willingness to engage in economic activity should remain, on a positive trajectory. So slow and steady, but bouncy, we expect from here on out. The easy gains are behind us. And speaking of, quote, easy gains, if you want to flip to the next slide, Ann, just a quick rundown on the stimulus update, which, this is kind of old news, and it's almost, I'm going to pull this slide out of here, but certainly, the lack of another round of stimulus does introduce additional uncertainty into the economic recovery story. In that regard, more stimulus from the federal government is better than less when it comes to economic recovery. People will have different opinions on what that means for the long-term debt burden and the like, but for the short-term economic recovery, more stimulus better than less. It looks like at this point it's pretty much not going to happen before the election. A little bit surprising to us. We were in the camp that we would get something done somewhere maybe in that $1.5 trillion range. I would say a week or two ago, we started to feel like it was looking less of a 60-40 proposition for yes and more of the other way around, 40% no. And I think the recent passing of Justice Ginsburg is going to proverbially take up all the oxygen in Washington for a while. And one of the outcomes of that kind of battle, if you will, is going to be the lack of a stimulus package being the base case at this point between now and the election. So the question becomes, is the recovery self-sustaining at this point? In the absence of a significant uptick again in hospitalizations or runaway virus counts, I think that on margin it is going to be self-sustaining, but it's going to be wavy. That's the theme, up and down, almost like that chart we saw with the open table, diners year over year. So self-sustaining, are we there at this point? I think we're getting there, but the gains that are easy gains have been already had. On the other side of the government story, if you flip forward to the next page, Ann, the monetary policy remains uber supportive. I'm sure many of you have been watching this. This slide actually predates the most recent Fed meeting. So we've actually gotten an even more dovish storyline from the Fed. I was actually quite impressed with their ability to deliver some significant guidance for future rates, basically saying we are going to stick at the zero interest rate level for now for the foreseeable future until we see inflation modestly higher for some time than our 2% target. And so we saw Fed projections that showed 2023 inflation at 2% or so, with interest rates still firmly in the zero camp. So the Fed is decidedly lower for longer. I was a little bit disappointed that they didn't couple their interest rate guidance on Fed funds with a little more firmer guidance on the quantitative easing program. I suspect that will be coming in the next few months, where they'll give us more direction as to how they're thinking about that longer term part of the curve, that 10-year buying. How are they going to do, are they going to change the QE, quantitative easing, dramatically? I think that they'll probably increase it, or at least provide more clarity on their thinking there, which they didn't do at the past meeting. But from an interest rate perspective, lower for longer is the theme. And they're not even thinking about raising rates in the near future. So we can comfortably suggest that interest rates will stay low for the foreseeable future. You can see our formal projections here on the 10-year is a gradual increase of the 10-year rate as the economy recovers back up just over 1%, 1.5%, if you will, next year. But that's predicated on not a substantial increase in buying by the Federal by the federal government in 2021. So we'll see if they give us any more clarity there in the coming months. Of course, the big caveat for their statement was we will keep interest rates low until we get 2% inflation, above 2% inflation for some time, not defined, so they have wiggle room obviously in the future to define that more precisely. But interest rate inflation is really nowhere on the horizon for the immediate future. And you can see their preferred indicator, the PCE, personal consumption expenditures, the core, and the total, right down in the sub 2%, 1.5% range. We did get a bounce off the lows seen earlier this month as pricing kind of returned to normal, if you will, and maybe some scattered pockets of upward pressure remain, but we expect those to be mostly transitory, and ultimately secular forces of disinflation, technology, you can see listed here, automation, e-commerce, teleworking, as well as demographics will continue to keep inflation low as well for the foreseeable future. At some point in the next 18 to 24 months, could we see inflation start to push up more significantly? We could. A couple of things could happen there. An economic recovery that is significant, self-reinforcing, could lead to that, of course. Some significant stimulus measures by a new administration, Democrat or Republican, could also, over the longer term, push inflation up. And then on the demographic side, we are tipping into a point where the baby boomer generation will be moving distinctly firmly into that retirement and later retirement years. And at that point, if you look at spending patterns over the course of one's lifetime, they tend to increase again late in life, primarily for healthcare and other related things, which could also change some of the demographic story, which could lead to some inflation. So inflation is really the key risk long-term. If you think about some of the stimulus policies and some of the low interest rate policies and the debt burden that we have today, but we don't see that happening in the near term. So a couple points then on the COVID-19 vaccine, and then we'll move on to the election. And if you want to go to the next slide, the next two slides. And a quick note, if we want, I don't know if that's Ann, if you had a question, or if others, maybe just to make sure, a reminder to keep your mics on mute so we don't get the background noise. But I'm not going to go through all of the the leading candidates for vaccines and where they're at. We do update this little tracker every week or every other week. It's available if you wanted to reach out to us at any time just to get the latest. We've got three primary firms that are ahead of the pack: AstraZeneca, Pfizer, Moderna. The moment is nearing. The moment is nearing. I'll just say that. We've been a big believer in the human ingenuity story, that this sort of modern Manhattan Project would lead to a much condensed timeline for some sort of, effective, quote, vaccine. And we'll see how effective these vaccines might be. But we should start to get results here sometime in October and November. The AstraZeneca Oxford University one was the most promising. We've had a bit of a setback there with a pause in the trial in the UK and now the US because of some adverse reaction or a single adverse reaction. But we are back in business in the UK. Trial has resumed. They're looking at the data in the US. That's the leading candidate. Pfizer and Moderna, a different type of vaccine, a little more complicated on the logistical side, has to be kept at very, very, very low temperatures, so it becomes harder to administer. But in a nutshell, long story short, we do still believe that by the end of this year, we will have an effective vaccine. In Goldman Sachs has another commentary on that. Just updated their forecast to say by Q1 2020, Q1 of next year, 70% chance that we'll have an effective vaccine. And that's up from 40% more recently. So the progress has been amazing. Did you have a question, Ann, there come in, or?
No, I was muting somebody who was unmuted.
Okay, sorry. So, but again, nothing is certain here. So it's all a game of probabilities. We are optimistic that we'll have a successful result, but we are not blind faith believers that it's going to be 90% effective and the magical cure right away. It might take several iterations ultimately to get us there. And the other thing we have to think about is people's willingness to get a vaccine administered, which studies have suggested many people would be unwilling to take a vaccine in 2020 or early 2021. So we'll have to see how that plays out. So I don't see it as the silver bullet, if you were, but it is definitely expected to have positive progress on this front over the next 3 to 6 months. So this is probably, in addition to the presidential election, obviously the big milestone that we're looking for in the next handful of weeks here. So turning to the presidential election, we'll conclude the commentary prepared with some thoughts here and then see if there's any other questions. I think we had a survey here, Ann, as well.
Yeah.
A real simple survey, just asking people to tell us your feelings about the importance of this election. And then I'll give you the national results for the survey in a moment. So if you can, Ann, we can pop that up. Question is...
One moment. We're having
Okay.
technical difficulty.
Well, the prelude is the percent of voters who have said this election really matters, or things will be the same regardless. That's really the question that I wanted to ask the group to see how you are landing relative to a national poll covering the same subject.
Okay, I just launched the poll, Mike.
There we go. So real simple.
Yeah, and I'll
Do you
share.
believe it really matters who wins, or things will be pretty much the same regardless of who wins? I'm sure the punchline on this one is probably pretty obvious because
I wish you could watch this, Mike.
yeah.
I would share it with you if I could. I'll share the results.
I think just in our daily lives, the amount of discussion around this topic is at an all-time high. So I suspect that people are aware what the general public feels on this topic. And maybe you can flip to that slide, Ann, and just show everybody, because this has been a question that has been asked by the Pew Research Center. Well, there you go. Unlike the other survey, this one fits squarely with the narrative of the general public, which is that people feel like this is a very important year and a milestone election. And that is consistent with the general population. And you can see here the trend up in this over time, various elections starting back 2012 to 2016 to right now, we're running in the mid 80%, which is aligned with what I just saw, about 90%. So we'll be interesting to see how turnout looks because of this heightened engagement come November, as that'll be one of the measures that probably likely decides the outcome of the race as well. So it's clearly a topic that is on everyone's mind. If we think about how things, and I'll mention again, for those that are interested, we did a very, I think, good discussion. Had a very good discussion on this topic about one of the things that is driving those numbers is this idea that the country is pretty polarized in terms of thinking. And we had a good discussion with a very well-renowned geopolitical strategist from a economic research firm just a few weeks back. And I'll offer this up, Ann, if people want to get access to the replay, they can just send you an email. It's a nice hour-long discussion. It talks about thoughts on who might win, implications for policy. We'll cover an abridged version here today, but also this idea that maybe this is the peak of polarization and going forward, we may align more closely to a centralized view of what the government should do. We'll see. But that's the view of this strategist. So it was a fascinating discussion. If people did want to get access to that webinar, just maybe contact you, and you can get us in touch with them, and we'll send links.
Yeah, actually, if you want anybody who is interested in that, I'm going to send the deck out and the recording for this tomorrow, and you can just respond to my email or send it separately. I just like to keep them all together so that we can make sure you get this separate recording.
Great, thank you. So here's a couple slides in terms of probability to win, and you know, many people may have seen these numbers quoted. Obviously, you'll see data on the polls, and that will be one commentary about likely winners and such. But an area that one of the areas that we follow for more real-time information is the prediction markets, and there is a website. Predict It is the name of the website. You can go on there and look at these betting markets, live betting for winning a number of the elections. Again, not a perfect forecasting mechanism by any means. It's just meant to be, I would say, a guideline as to the trend. And you can see here on the top left, right now, the betting markets are suggesting that Biden will win the election. You bet about 58 cents to win $1. But the key thing here is you can see the trend converged over the course of the summer and has widened again recently. Same thing on the right-hand side of the page, which shows the prediction markets thinking about a Democratic House and a Democratic Senate. So the blue line would be the kind of blue sweep there in terms of a Democrat House and Senate. Red line is representative of the Democratic House, Republican Senate. Again, convergence late summer, divergence recently. Our view is that a lot can happen still between now and the election. We've certainly got the debates that will be taking place soon. We'll have a lot of vaccine news that will be taking place soon. And if we couldn't get another curveball from the political spectrum, we did just get the Supreme Court discussion land at our doorstep here over the past few days. So our view is that these numbers will likely tighten heading into November. And we're probably at this point still thinking that Joe Biden has the edge, but it's not much better than a coin flip. So it's going to be very close, as is probably stating the obvious. But right now we assign a small probability favoring Joe Biden, but again, things can change over the course of the next handful of weeks, and we expect them to change, and we expect the race to tighten a bit further from here. So if you scroll to the next page, and just a couple of thoughts on what this might look like. And I'll just focus on a few of these because it's not that clear cut that there any scenario. Again, this is a capital markets scenario. We're talking about, risk assets, equities, and the like, the bull and the bear case here. So this is not a policy commentary. This is just a commentary on the impact for the public markets and the private markets as well. Likely this idea that, President Trump wins, Republican Senate. You can see all of these have both pluses and negatives. On the plus side for that scenario, we'll still have a tailwind on the regulatory environment and the tax environment. The three major things it's worth noting that administrations, President and Congress control that are able to influence the economy over the intermediate term are regulations, taxes, and spending. And, this is a $20 trillion economy, so there is not, at the end of the day, that much one administration can do at any point in time to influence that, because a lot of it's already set in course what's going to happen. But those three things, if you think about, those are the primary three things that administration can do. Generally, we view that, a Biden presidency would be much tougher on the regulatory front. Energy, financials suffer in that environment. President Trump would be more friendly on the regulatory front for those sectors, as a for instance. On the flip side, a President Trump remaining in office is likely to continue the tension with China, maybe spark some new trade battles, especially when there's not the need to consider a re-election scenario. So any need to balance that trade tension with destabilization of the economy because a re-election is coming. So we might expect more tension on the trade side from a President Trump administration, which has winners and losers as well. On the flip side, if you think about the kind of bottom scenario, President Biden and the Democratic Senate, so the blue wave scenario, and a 50-50 Senate, of course, is noted there, is much different than a landslide victory with a mandate. So there'll be a lot of scrutiny of the details here for who might support, more progressive Democratic policies in a close Senate race versus one that is a clear mandate of a win. But in that case, we're looking at probably significant additional fiscal spending. Healthcare would be a negative in that scenario. Infrastructure, positive, and the like. So it is. Healthcare is listed here as a positive because some of the benefit managers would be benefit in that scenario, but pharmaceuticals, which is the bigger portion of the healthcare industry, would be negatively impacted by that. But that's probably the scenario that is most risky for the overall market. I think the general idea here is with this page, each scenario has its pluses and minuses, and there'll be winners and losers, industries and regions. And so the devil is going to be in the details on this one, because it's not clear that one scenario outshines all the others as the green light for the economy or the stock market. But the President Biden administration with the Democratic Senate has the highest likelihood to perhaps hit the stock market in the short run. If you look at the next page, and here we can talk quickly about the tax side of the agenda. Clearly, there'll be a huge spending agenda covering infrastructure, healthcare, opioid crisis, and the like. The kind of Made in America plan that's been discussed, it covers a whole host of things to the tune of maybe $5 or $6 trillion of spending. Has to get made up somewhere. Here's a look at thoughts on where that makeup might be coming from in terms of additional government revenue. And you can see the top line is the biggest impact to probably overall corporations, right? And overall public market equities in the form of a raise in the corporate tax rate, maybe perhaps back to 28%. Again, disproportionately favoring some industries over another. We think something like that could negatively impact real estate sector at the high end, technology sector, healthcare sector, versus consumer staples, industrials are less impacted. But if you flash back to the tax law changes made under President Trump's regime, we saw a one-time move up of about 16% in EPS growth, or not EPS growth, earnings per share moved up about 16% as a result of the tax law changes. We would suggest that probably EPS could move down maybe 11 to 12% as a result of this sort of scenario playing out here, which would be a negative for sentiment on the stock market. Again, in the short run, it's quite plausible that the longer term impact of some of the spending overweighs the tax, but that's something that, again, we'll have to see, and the devil will be in the details there as we move forward. So strictly speaking, each scenario strictly speaking from a capital markets perspective, each scenario has pluses and minuses, but the all Democratic sweep is probably causes the most near-term volatility for the stock market. So I'm going to maybe conclude, Ann, one more page, and then we'll wrap up here and see if there's any questions that people want to ask. Just a summary. Couple quick points. GDP rebound. We do think we'll persevere here, but it's likely to be wavy, right? So we're going to see a little choppiness. and there will be continued winners and losers on the industry front. That'll be exacerbated most likely by the upcoming election as well. The Fed is, even though fiscal stimulus would remain an important element to sustain consistent economic momentum, we probably won't get that. But the Fed is there to support the economy for as far as the eye can see at this point and doing everything we can. So that's a positive for economic growth and for equity market performance. As I mentioned, Democratic sweep could introduce the most near-term market volatility. And so I'll just end with a comment on our current positioning. Again, we do remain, for our overall reference portfolios, which again is just a series of considerations that we put out as a centralized group to our teams around the country. They make individual decisions based on every client. Todd and his team would take all of our inputs and bring that to their individual client base and make tweaks as necessary for that specific situation. It's one of our unique sort of, I think, attributes as it relates to our setup. But for our baseline, we're saying you want to have what we call a balanced profile here. We do think having a overweight equities with a focus on the US market, larger companies, quality growth companies still makes sense for the intermediate term. But we want to couple that overweight with a balance and maybe a cash buffer whereby you have some dry powder to act opportunistically if we did get a sentiment-driven sell-off because of something unforeseen around the election and the like. We're also looking at other more specialized sort of products in the form of different structures that allow us to hedge a little bit of activity in the not too distant future, which is something we've been doing more of. So it all fits in that balance theme. On the right-hand side, you can see our preference scale. We've been more active than normal recently because we think that's warranted. I said we like US over international. We like large cap over small cap. We like quality over deep value and speculative growth. Same thing on the fixed income side. So that is where I'll end things there, Ann. That's a lot of ground. We covered a lot of things, the market, the virus, positioning. Happy to take any questions. I appreciate everyone sticking with me there for that long, long individual monologue, if you will.
So I am going to open up the floor for questions. I'm going to stop sharing here. And just before I let you stop sharing, just want to make a little plug for Loyola's upcoming program. Some of these things will be coming to you in the deck tomorrow. And then I am actually going to stop sharing so that if people would like to raise their hand and ask questions, I'd be happy to monitor that and bring people on. Let's see here. This is your opportunity to ask the experts. One thing that came up as you were going through this, Mike, was, I know this is a perspective that has to do with the capital markets, the stock market in particular, and the election. But, family businesses are, while they are affected by the market, they're not necessarily aligned necessarily. And I think somebody was referring to that earlier. For the people that are on the call that are trying to think about how to position themselves for the next 3 to 6 months, do you have any advice or counsel that you'd like to share with them?
Yeah, and Todd, I'll ask you to jump in here too. It's a good point, and thanks for that. Commentary around the public markets and those firms and what's going on there might be different than the host of impacts for private business owners. And I don't know what the makeup, Ann, of the industries that might be present. I'm sure it's probably a pretty diverse group. So I would say that the individual, each industry is going to have its own set of special circumstances. I think that you can expect, though, in a broad sense, a gradual economic recovery. So I would say a continued rebound in demand fueled by progress on the medical front and a non-acceleration in severe cases of COVID, and also by a drawdown in the tremendous savings rate that consumers have. So it is, we were many consumers saved a lot of money when they received those checks from the government recently, or curtailed spending when they kept working and couldn't do anything. And that's something that we think will factor significantly into providing that self-sustainability going forward. So that's one thing. So we'd see continued consumer strength. We do think that those certain industries, though, leisure, hospitality, restaurants, that stuff, they're going to struggle for a while. And the winners are going to be the housing market, the auto manufacturers. So industrial production, we think, will continue to trend positively, durable goods and the like. And I think there's also going to be, regardless of the administration that we see, there will be a continued onshoring focus. As a colleague of mine at a partner firm likes to say, middle America is the new emerging market. And I think that's true, in that people will look to bring production and focus back to the US because of sort of increasing borders around the world, and the fact that some of these low-cost producers now are no longer that low cost. So, it's hard to give specific advice there, and without knowing the circumstances. The other thing I would say is we think inflation will stay low, interest rates will stay low. Funding is going to be very accessible for businesses that are, have a good balance sheet. If not, funding will be challenged, and that's probably what people are experiencing, because bank lending standards have tightened up recently. And there's the big difference, right, between some of these big public companies that can easily access versus some private firms that maybe cannot. So you have to watch liquidity closely. That's probably preaching to the choir on that front. But those would be some things I would mention. But thanks for the reference on individual business owners versus public markets. Todd, is there anything you want to add from your conversations with clients and the like on that subject? And just be careful, you're on mute there, Todd, in case you didn't see that. I just want to make sure that you have it before you start.
Huh.
There you go.
Sorry about that. But Mike, I was going to add that one of the things that's nice about the way we work with clients, every situation is different. We really rely on the financial planning process. So if anybody has further questions or would like to engage us, we'd be happy to take a closer look at the situation to really make some custom recommendations there.
Well, and I don't mean to make you guys put on your commercial banking hats, but I do know that you reach across the aisle and talk to your commercial banking partners too. So that's often my experience working with you all, is that there's a more holistic approach.
The other thing I'll mention, just topically, and the things that are top of mind as it relates to big trends that I've seen. Some of the survey data is coming back now on these PMI indicators that suggest finding labor has now become a bigger issue than it was only a few months ago. And I think that's probably finding qualified candidates, because obviously there's a big pool of folks out there that are unemployed, and if they're not actively looking, maybe they would be in the near term. But we've heard companies, and I've talked to a handful of CEOs on this topic, thinking about how to set up training programs and the like to retrain some of these people coming from other industries that may not have been, exposed to the same types of industrial applications that I think will be a growth area. Again, at the expense of those sort of hospitality, leisure, and the like, and the energy sector too, we think will remain under pressure, which is, we didn't talk about that much at all, but we do think, if I was to give you the formal forecast for oil, prices, we would think probably, somewhere in the 40s is the right area for throughout 2021 as we balance between economic recovery and wells that have been shut, so not ability to kind of turn production back on a dime. So we think that sort of the equilibrium there is probably in the 40 something range. But that's also a very politically driven field as it relates to OPEC and the like. So I do know there's a lot of engineers and things in that field that are recently out of work, looking for ways to reposition their skill sets as well. So,
well, great.
I have a question. You're talking about large cap companies are doing really well lately. Probably in this group, we're dealing with a lot of family-owned businesses.
Yep.
And to be a little smaller, but I've also heard another theory that now is the time for family-owned businesses to really think about becoming a bigger business. And I wonder what your thinking is in terms of the future for family-owned businesses, given our current environment.
Yeah, well, great, good point on the time to become a bigger business. Look, there is no doubt that the last few months have revealed a trend that existed already, which was, and this is a generalization, so it might not be specific for every industry. Scale wins, right? We are in a scale. It's in all of our businesses, in the banking business, in the technology business. There's not a business you can't probably point to. Why? Because it allows you the ability to invest in the technologies that you need to interact and interface with the customer. And then, there's no better example of that than, call it the, fast casual or fast food chains, right? Versus restaurants, small businesses on the restaurant side. You could go on your phone and go to Chipotle and order something on an app that you don't have to touch anyone or talk to anything. You walk in the store, you pick it up, you leave. Tremendous increase in business for Chipotle over this time, at the expense of traditional restaurants that don't have the ability to invest in that type of, and so I just think that technology, again, I'm just making a universal statement here, so it doesn't probably apply. I think that need to invest in capital, to rethink the way that people engage with the front end customer is pretty much almost a universal facet of life. And that's something that probably drives bigger and consolidation to be able to do that. I know we see it with most of the managers that we're working with that operate in the private equity sector. That's the name of their game, trying to get scale to make critical investments to then offer higher and better margins, but really just to compete, right? So, so to that, I would say it's probably now would be a time to think about bigger is better. And if you're in a position of strength from a balance sheet perspective, and I talked to a lot of small, not small even, but family businesses that are have been very prudent about their finances and could be on the hunt at this point because they might have access to capital because they were very, like I said, had strong balance sheet. I think now is a really good time to consider thinking about that.
Yeah, this is where patient capital pays off, right?
Yeah.
Right.
Right. Okay, if we don't have any more questions, I think I'm going to give people their 10 minutes back for the rest of the day. Big thank you to Mike Stritch and Todd Riggin. Thank you so much for joining us today and for sharing your wisdom with us. As I mentioned before, I will be sending out the deck and recording tomorrow to everybody that registered for the event. And if there is another question you might have along the way, please feel free to reach out to me at asmart@luc.edu. And also, one of those questions was if you would like to get a recording that BMO had with their, what was it?
Geopolitical strategist. Yeah, it was more specific on the election and those types of things. Yeah.
Great. Then we can make sure that happens. And then my final little bit of fun is that on November 12th, we're going to have a futurist, again, keeping our eyes on the horizon, coming together for our virtual fall conference. And we're looking forward to that. We'll be doing about a 2.5-hour conference, virtual breakout sessions led by facilitators. And hopefully we can dig into some of these other proposed ideas for the future on November 12th. Until then, please reach out to us for anything you need. Both Andrew Kite and myself and Smart are here to help you as a family business. Love to connect you with one another and love to connect you with resources. Thank you again, Mike and Todd. Have a great day.
Pleasure. Take care.
Bye-bye.